Hello everyone. In today's lecture, we'll be talking about IFRS 5, non-current assets held for sale and discontinued operation. Now, this lesson is going to be focusing on four major aspects, which includes the conditions that must be met for an asset to be classified as a non-current asset held for sale, the measurement of an asset once it is classified as held for sale, the method of presentation in the statement of financial position, and the disclosures. Now we'll begin this lecture by defining a non-current asset held for sale. When we talk about an asset that's held for sale, these are assets that an entity intends to sell in the nearest future with hopes of recovering the carrying amount of that asset through its sale rather than through continued use. That means the entity no longer wants to put the asset in use because they believe they can recover the cost of the asset from selling it rather than continue usage. Now that we have an understanding of what assets held for sale means, we are going to be moving to the classification as an asset held for sale. IFRS 5 requires that there are certain conditions or criteria that must be met in order for an asset to be classified as a non-current asset held for sale. Now, I know we might be confused because I keep using the word classified. So I'm going to use this instance to explain it. So now, in our statement of financial position, let's say we have non-current assets, right? And the value is 1,000 naira. And included in that non-current asset of 1,000 naira, we have a motor vehicle that the entity no longer puts in use. Now, when we talk about reclassification and non-current asset held for sale, it means that the entity now wants to sell that motor vehicle. So therefore, it can no longer be categorized under a non-current assets because this vehicle is no longer going to be used by the entity in delivering of services or production processes. So now they want to sell that assets, motor vehicle, right? So we are going to move the motor vehicle from the non-current asset and we are going to move it to non-current assets held for sale. So now that is what we mean by classification. That is what we mean by reclassification. I hope you understand now. So now IFRS 5 says that there are certain criteria that must be met for that motor vehicle to be reclassified as a non-current asset held for sale. These assets must meet these criteria before it can be classified, before we can consider it sellable. So here are some of the conditions. 1. The asset must be available for immediate sale in its present condition. So now, that motor vehicle does not need future repairs, like it does not need any form of repair before it can be sold. It should be sellable in its present condition. Let's say I have an iPhone and I want to sell it. Like I don't need to make any adjustments to it that would hinder its sale if a buyer should come this instant. No, it should be sellable in its present condition. It should be ready for immediate sale. Just like when you go to a shop and you purchase a bread with immediate effect. You're not hearing, we need to package, we need to do this. No, it is sellable in its present condition. The sale of the asset must be highly probable. What does this mean? It means that there's still a demand for that asset in the market. So it's not obsolete. People still want to buy it. It's still in use by customers. That way we know that there's a possibility that the assets can be sold. 3. The management is committed to the plan to sell. So now we know that management have made up their mind to sell that assets. It's not, oh, we might want to sell it, we might not want to sell it. They are sure and certain that this asset is now put on sale. So if a buyer comes now, the buyer can pay and get the asset. So they are certain about their decision to sell. 4. The price of the asset should be reasonable in proportion to the current fair value. So what does this mean? Like the asset should be marketed at a price that is reasonable. So let's say for instance we have a bucket, right? And the market value of that bucket is 15 naira. the entity should not now put a price of 100 naira on the bucket because it is not reasonable. So if the entity does that, then the asset does not qualify for reclassification. I hope you understand. Now, let's talk about number 5. The sale is expected to be completed within 1 year from the date of classification. So now, let's go back to our first instance. When that motor vehicle has been reclassified as non-current assets held for sale, now we do not expect it to keep being classified as non-current asset held for sale for a period of 6 years. No, it should be like plans should be in place to sell that asset within 12 months. The entity, the company should try all their possible best to sell that asset within 12 months. Then we have there's an active plan to locate a buyer. So maybe advertisement, using social media, using a broker like third party sale, but there should be an active plan to locate a buyer so customers are informed that this asset is available for sale. And finally, it is unlikely that the plan to sell the asset will change. So like we said before, the management is committed to that plan to sell. So they are not changing their mind. So if they are not changing their mind, it is unlikely that that plan will change. I hope you understand. So these are some of the criteria. These are the criteria that have to be met before an asset can be classified as a non-current asset held for sale. So let's move to the next slide, measurements. So once an asset has been classified as a non-current asset held for sale, meaning it has checked all the boxes like with the criteria. So now we are certain that this item can be classified as a non-current asset held for sale. The next thing to consider is how do we measure the value of that asset? So what price are we going to put in our statement of financial position? So what's the value of that asset? So now IFRS 5 has given an answer to that. According to IFRS 5, items classified as held for sale should be measured at the lower of fair value less cost to sale and carrying amount. So just in case you're new to accounting, I'll be explaining some of these terms. Fair value. So what do we know as fair value? Fair value, this is the current market price of an asset at the measurement date. So for instance, I go and buy a sweet, like the current market price of that sweet in the market at that day, that is what we call fair value. Carrying amount now refers to the book value of an asset. So it is the cost of an asset less all accumulated depreciation and amortization. So let's say we buy a car at 1,200. We know that the price of that car is not going to be the same. We know that the value of that car is depreciating, right? So maybe in the first year it's going to depreciate as 200 naira. In the second year, another 200 naira. So now let's say we are asked to find the carrying amount of the car in the third year, right? We are going to say 1,200 minus 400 naira. So that will be 600. So it is the cost of an asset less all accumulated depreciation. Then we have cost to sell. Cost to sell, this is the amount spent to sell an asset. So let's say advertisement cost or the money paid to a valuer, the person who valued the asset before sale. So all those things are considered as cost to sell. So now IFRS 5 is saying that an asset should be measured, a non-current asset held for sale should be measured at the lower of fair value less cost to sell and carrying amount. So while trying to figure out the value of the non-current asset held for sale, there are other situations which you might come across. For instance, we have a situation where the fair value less cost to sale of an asset is lesser than its carrying amount. In a situation like that, you would need to calculate an impairment loss because now the entity has it in their books that an asset is maybe a value of 1,500, but then you go to the market and you find out that the asset is no longer valued at 1,500. In fact, the value has become lesser. So now maybe 1,000 naira. In this situation, we would have to recognize an impairment of 500 naira because there is a decrease in the value of the asset rather than an increase in its value. A situation in which the entity valued its non-current assets using revaluation model. So usually in IEX 16, assets are usually measured at using revaluation model or the cost model. So now at revaluation model, asset is valued based on the current market value, right? While using the cost model, the asset is valued at the initial cost of the asset less other accumulated depreciation. So yeah, so that's what the revaluation model and the cost model stand for. So now in an instance where the non-current asset is measured using the revaluation and it also meets the criteria of being classified as a non-current asset held for sale, what do? The first thing you do is revalue that asset using the revaluation model. So if the carrying amount usually is already 1,000 naira in the books of account, but then there is a revaluation and the value increases by an extra 500, you revalue that asset using the revaluation model. So since the carrying amount was 1,000 naira and now there's an increase of 500 naira, so what is now the revalued amount? It is 1,500. So if you're recording it in your book, you're going to record the carrying amount of that asset at 1,500 naira. So now that is what IFRS 5 is saying. First things first, you revalue it using the revaluation model. So now we have 1,500 naira. So after you've done that, what next do? You revalue the asset again at the lower of fair value less cost to sale and carrying amount. Remember now our carrying amount is 1,500 naira. So now what is our fair value less cost to sale? Let's give an instance that our fair value less cost to sale is maybe 1,100 naira, right? So now we have to choose the lesser of both. So what is the lesser one? Right now we know that the lesser is 1,100 naira. So therefore, now that the asset has been classified as non-current asset held for sale, the value we'll be putting there is 1,100 naira and not 1,500 naira. I hope you understand. Yeah. So another thing to note is that depreciation ceases to exist once an asset is reclassified as a non-current asset held for sale. So you do not recognize depreciation again once it is classified as non-current asset held for sale. Why? Because the entity wants to sell that asset. So we do not want a situation where the value keeps dropping and dropping and dropping. Nope. So we do not consider depreciation anymore. It's just like your inventories. Let's say a company that produces computers now, so therefore their inventory are laptops, right? Now they would not now be depreciating those inventories just because they are computers. No. So you do not depreciate your inventory, and so therefore you do not depreciate your non-current assets held for sale. I hope you get that. So now let's move to the next thing on our plate. We have presentation. So how do we present this information? Now we agree that the assets meets the criteria of IFRS 5 for reclassification. We now know how to measure the asset. We know what the value of the asset is. So now how do we present that information in the statement of financial position? So according to IFRS 5, assets classified as held for sale is presented separately from other assets in the statement of financial position. Don't worry about it. You're going to see an illustration in the later slide. Another thing to note is that liabilities of a disposal group classified as held for sale is presented separately from other liabilities in the statement of financial position. So again, we have all our liabilities listed. It is neither a non-current liability nor a current liability. We would have it there as held for sale. Next thing to note, where an asset or disposal group is classified as held for sale after reporting date but before the issuance of the statement of financial position. Details of the assets or disposal group should be disclosed in the notes of the accounts. And the reason for this is because that event now is considered as a non-adjusting event according to IFRS 10. If you want more details on IFRS 10's adjusting and non-adjusting events, kindly leave a comment and I'll make a video on it. The next slide shows an illustration of the statement of financial position for a non-current asset held for sale. So now you can see that we have our non-current assets as X dollar and we have our current assets. Under our current asset now we have cash, inventories, receivables, and then you will see our non-current assets held for sale. It is categorized separately because it is not considered a non-current asset. Assets are things owned by the business that are utilized to bring in more cash flow for the business, right? So it is not a non-current asset and it is not a current asset. So therefore, what is it? It is a non-current asset held for sale. Why? Because it is an asset that was once owned by the company, but now they want to sell it off. Let's talk about changes in the plan to sell an asset. What does this mean? Like, there could be various reasons why there would be a change in the plan to sell an asset. Like maybe an asset was expected to be sold rather within the period of 12 months, but it was not sold. Let's say that the management have changed their mind concerning selling the asset. So those are what we refer to as changes in the plan to sell the asset. So now, what does IFRS 5 say we should do in this situation? According to IFRS 5, if an asset is not sold within a period of 12 months, IFRS 5 states that that asset can continue to be classified as a non-current asset held for sale if it meets the following criteria. So now, the assets, yeah, we know we said that it should be sold within a period of 12 months, but if something happens and then that asset has not been sold, IFRS 5 says we should continue to classify it as non-current asset held for sale as long as it meets this criteria. What are the criteria? One, the delay of the sale of the asset is as a result of events or circumstances beyond the entity's control. So what does this mean? Let's take an example of when COVID happened. What company on earth could stop COVID from happening, right? So that is an event that the businesses could not control. So let's assume at that point the entity has put out an asset for sale and people were not buying. The business couldn't control it. So therefore, if that criteria is met, they can continue to classify it as non-current asset held for sale. Number two, if there is sufficient evidence that the entity is committed to the plan to sell, that is, we can see the effort of the entity trying to sell the asset, we can see that they are trying to locate buyers, we can see that they are advertising, we can see that they've actually put this asset out there for sale, then it can continue to be classified as non-current assets held for sale. But if the criteria of IFRS 5 is no longer met, assets must cease to be classified as held for sale. So if it does not meet these criteria and the initial criteria are no longer met, nothing like classification as held for sale anymore. It will now go back to being a normal asset. And how do we measure an asset? How do we measure an asset which was once non-current asset held for sale? IFRS 5 said it should be measured at lower of its carrying amount before reclassification as held for sale, adjusted of any depreciation, amortization, or revaluation that would have been recognized. We already talked about how we get our carrying amount. How carrying amount is the initial cost of the asset less all depreciation and amortization. So that is what this IFRS is telling us here now, that we go, like, let's say for instance the company puts out my phone, for instance, on 20 on 1st of March 20x3, right? He puts out this phone for sale, right? And now this is maybe this December 31st 20x5. Now if we want to measure it now and take it back to being an asset, we'll go back to the year 20x3, and it's that value that was there that we're going to put less all the depreciations that would have been recognized in 20x4 and in 20x5. So we are going to less those, and so that is the amount that will be considered. So the lower of that amount before reclassification and the current recoverable amount as at when the decision to no longer sell the asset was made, that period that management say okay, we are not selling, no, if the value was 1,000, it is that 1,000 naira that will be considered. You do you understand? So now remember, what we are now checking is that value as at the date of reclassification less all necessary depreciations and amortization, and the value as at the day that management changed their mind about selling that asset. So the lesser of those two values is what will be considered. So let me give a brief instance. Let's assume the carrying amount of a computer system which a company no longer uses is $1,000 as at 20x1, and now currently it is the year 20x5, right? So it was 1,000 at 20x1, and currently now it is 20x5. And after the asset had been reclassified as non-current asset, management decided to no longer sell the asset in 20x5, and the current value of that asset is $2,000. We are going to now take the carrying amount of $1,000 and will deduct unnecessary depreciation, so 20x2, 20x3, 20x4, then 20x5, that is for the months that might have occurred. We are going to deduct all necessary depreciations that would have been deducted at that period. Remember, the reason why we are deducting this depreciation now is that once an asset is classified as non-current asset held for sale, depreciation does not exist anymore. So if it was 1,000 naira in 20x1 as a non-current asset held for sale, 20x2 1,000 naira, 20x3 1,000 naira, 20x4 1,000 naira. So you can see that depreciation has not been deducted at any point. So that is why now we are going to be deducting that depreciation. And let's say it's a depreciation of $100 for each year. So now we have 20x2, 20x3, 20x4, then maybe half of 20x5, right? So what do we have? $100, $100, $100, $50. So that would be $350. Now we'll deduct that $350 from the $1,000, and now what do we have? $650. So remember, we have $650 and the $2,000 as at the day management say they are no longer selling. So now which one will be recognized? It is obviously the $650 because IFRS 5 say it is recognized at the lesser of it, the lower of it. So now $650 is what will be taken to our books of account. I hope you get it. Now let's see disclosures. In the period in which a non-current asset has been held for sale, IFRS 5 says that the entity must disclose the following. 1. We have a description of the non-current asset or disposal group. So what is this asset? Like a description. 2. A description of fact or circumstances of sale and expected sale. 3. Impairment of losses recognized. So now if you get to your exam hall and they ask you what are the things that IFRS 5 says that an entity should recognize, these are the 3 things you're going to be listing. Before we conclude, let's take an example. Teco is a production company. On the 1st of March 20x5, Teco's management decided to sell one of the production machines used in their old factory. The board has formally approved the plan to sell the machine and has hired a broker to start advertisement for the machine sale at a cost of $480,000. The selling cost is $20,000. The machine is physically ready and available for sale in its current condition, and the carrying amount of the machine on the 1st of March 20x5 is $500,000, assuming no significant depreciation between the 1st of January and the 1st of March. So this is a very simple and interesting question. And so we have to check one, if the necessary criteria of IFRS 5 has been met. Two, the measurement based off of IFRS 5. So let's begin. Step 1. The first thing you always check is whether the criteria of IFRS 5 has been met. Check 1. Committed to the plan to sell. We have to check now if management is committed to the plan to sell. And based on the illustration, it was stated that the board has formally approved the plan to sell. So we can see a level of commitment from the management, right? So that criteria has been met. Then we have sellable in its present condition. It was also stated in the illustration that the asset is physically ready and available for sale. So there is no necessary adjustment that has to be made to the asset. The asset does not require repair. It does not require painting. There is no reason to pause the sale. The sale can happen instantly because the asset is ready. So that criteria has also been met. There is an active plan to locate a buyer. As seen in the illustration, a broker has been hired, right? In fact, he has started advertising. So that criteria has also been met, and it is marketed at a reasonable price. So now the asset is being marketed at 480,000. When compared to its carrying amount, which is 500,000, the price is even lesser, so it is quite reasonable. But let's give an instance that currently in the market now, the value of the asset is $200,000, right? And now it's being marketed at $480,000. Then we can see that it is unreasonable, because why would you add a whole sum of $280,000 on top? That would be unreasonable. But now we can see that the price is quite reasonable. Then we have sale is highly probable. So from the illustration, we can also note that Teco is actively marketing the asset, and the sale can be expected to be completed within a year if all things are equal, if there is no unexpected occurrence. So based off of this and all this, we can draw a conclusion that the asset should be classified as a non-current asset held for sale. This is because it meets the required criteria of IFRS 5. So I hope that is clear. So now what next? It has met the criteria of IFRS 5, meaning that it passes to be reclassified as a non-current asset held for sale. The next thing we do is the measurement. What does IFRS 5 say concerning measurement? It should be recognized at the lower of fair value less cost to sell and carrying amount. From the illustration, we have our carrying amount as $500,000, and we have the fair value as $480,000, and we have the cost to sell as $20,000. So fair value less cost to sell, this simply means the fair value of the asset minus the cost to sell that asset. So what do we have now? We have $480,000 minus $20,000, and that would result to $460,000. So now what do we do next? We check between our fair value less cost to sell and our carrying amount, which one is lower, and the lower is $460,000. That is because our carrying amount is $500,000, right? So now we also know from the lecture that if the carrying amount is higher than the fair value less cost to sell, we have to recognize an impairment loss. Why? Because the carrying amount is higher than we are going to sell this asset, and in our book of accounts now it says that the cost of the asset is 500 is worth $500,000, but you carry out a market survey and you find out that it's worth $460,000. You can see that there's a reduction, and that reduction now is called an impairment loss. So now what do we have as our impairment loss? $500,000 minus $460,000, that will result to $40,000. So our conclusion: the asset should be recognized at $460,000 and an impairment loss of $40,000 will be recognized in our income statement as an expense. I hope this video gave you a clear understanding of IFRS 5, and if you liked this video, please don't forget to like, subscribe and leave a comment on the next standard you would like me to teach on. Thank you.